So it's been an ugly week in the stock market, and believe it or not, we are heading towards the back end of 2022 now, and going into 2023, people are already talking about what market will we see going into 2023, and will there be a continued crash in that year as we've seen in 2022. So what we're going to do today is we're going to talk about what the chances are of us having a continued crash in 2023 going from here. So I hope you enjoyed the video. So before getting to what's going to happen in next year, it's key to look at what's happened this year. So this year has been a tough year in the market. It's been the worst year for 14 years. The last time it was this bad was the Great Recession, and many of you guys may not have been investing in that time frame. That was by far a horrible period in the economy, in the stock market, in the world. There was a lot of things going on in that period of time. There was a mass amounts of unemployment. There was a ton of businesses collapsing. The whole banking system was on the verge of collapse. And that is correct. We are currently at the worst period of time, currently at the moment, on the stock market basis, as we were in 2008. And after that, you're talking the tech bubble. That was the last time we saw a market that was as awful as we're seeing right now. So there is already a lot of negativity priced into the market going into 2023. We have had a very, very tough year. On the way, we've seen stocks crash a huge amount. We've seen a lot of retail investors basically pack the bags and go, you know what, it's not worth it, I'm going to leave the scene here. And that's been clear when you look at many share prices out here. One of the key things that will probably finish 2022 off is we've got Q3 coming up. We've got Q3 coming up around about that last end of October, towards the first week of November. We'll really get the last bit of information this year on how businesses are doing. Obviously, we won't get Q4 until 2023. So this is the last bit of financial data that we'll get. Very key to see what businesses come out with, because as we know, there's been a really big mixed bag of what companies have been saying. There's a few businesses that have been coming out and going, yeah, everything's fine, or a few businesses that going, there's a few little issues, but it's not too bad. We've seen a few businesses come out and go, for example, FedEx, and go, you know what, it's getting worse as the months have gone on, and we're just going to pull our guidance. So there's a really big mix of how bad this recession is out there. Obviously, we know we're entering a bit of a slowdown. The multi-million question really is, how bad is that slowdown in that recession? And when you look at what's being priced in 2022, it's clear that there's been a massive slowdown in the economy priced in. The ultimate question is, how much worse can it get from here? If it goes a lot worse, then we're obviously going to have a bad, terrible next year. If it is already a lot of negative priced into the market, then potentially we could have a good year. And these are probably the key points to be looking at. First of all, like I said, there's a lot of fear out there, a lot of fear priced in. When you look at the stock market right now, you've seen share prices have tanked back to where they're at pre-CV levels, and in that time you look at a lot of businesses, then businesses have improved their profit and revenue in that time frame. However, the valuation of the business has gone back down to where they were 2 years ago. So there's a lot of fear out there, a lot of people leaving the market. Believe it or not, in a very high inflation period, a lot of people have gone back to holding cash. It is unbelievable, but that's the negative market that we're currently in. Now, obviously, one of the key points is inflation. That has been the root cause of a lot of problems this year in the stock market. Inflation has been going up a massive amount, and typically, historically, when inflation is high, unfortunately, the stock market does not perform that well. For the stock market to perform that well, we need to see inflation around the 2% mark. Now, when we do look at inflation at the moment, we have seen inflation peak actually since March time. So on the inflation front, we are doing actually pretty good here, and we'll be moving very much towards that 2% range very early on in 2023 if this keeps up. So that's one thing to be keeping an eye on. As we know, stock markets perform best when inflation is at a lower rate, and also historically when inflation does peak, that normally leads to a good run in the stock market, which we are yet to see. Obviously, when the historic data says the average return in the next 12 months of inflation peaking is a 10% return in the S&P, obviously we are currently not seeing that 10% return, even though inflation at the moment suggests that we peaked a couple of months ago. So the data and historically at the moment, key thing, inflation has peaked, and as long as inflation does peak, that would actually set us onto a really positive 2023. The only little thing is, if inflation then does start going up, then that's obviously going to be a little bit of an issue where we could see a bad year in the markets. Obviously, another key thing to that is oil. Oil has been the main driver of why we have seen inflation go up so much. And at the moment, oil is coming down at the moment. It still has a fair way to go to get back to levels that are a lot more better for the businesses and inflation and consumers. So we do still need to see oil coming down, but there's no surprise that inflation has peaked because oil is coming down. The last time we saw a very high period of an inflationary environment, when we go back to something like 1980, what was the root cause of that big peak of inflation? It was oil, and we basically got a complete replica of what happened in that period of time. So this is key. At the moment, it's looking okay. The more we look at oil, oil's on the way down. So we're actually having one of the main issues that caused the crash in 2022 being resolved. Now, obviously, like I said, being resolved, it not has been resolved, and that's the key thing to look at. But from a positive in 2023, that's obviously a good thing. Probably one of the things that have been underestimated here is this one, China. China has been opening up, locking down, opening up, locking down again, and that's actually caused a lot of supply chain issues through 2022 and 2021. Obviously, there's a lot of China supply, a lot of different things around the world, and with factories opening up and closing down, that's obviously caused a massive imbalance. Now, there is not really a certainty on that one. I would say that looks a bit more negative than, say, the inflation, because inflation, as we can see, the data is good there. China, not so good. Obviously, at the moment, we see spike of CV cases in China, and also because we've seen a less of an adaptation to the vaccination program, there's also that explosion of cases that we're seeing over there, and it looks like that's not going to be resolved anytime soon. That's one issue though that I think is key to see happening in 2023. The next point is this one, and this is probably one of the people talk about a lot of negatives, but this is the key. Employment is key. Employment is key to have a very good economy. At the moment we're having a bit of a slowdown. We're having a slowdown because we've got inflation here. People have got less money to spend, and that's causing a slowdown in the economy, and obviously it isn't great. But a slowdown in the economy, a little recession is absolutely fine and manageable. We're at a situation where people are going, okay, money's a little bit tighter. Instead of going for that meal out that we go to every week, we're going to go once a week. That trip to the cinema that we do every month, that's going to be 2 months. Them 2 holidays we take a year, that's now going to be 1 holiday a year. There's the tightening of spending at the moment, and then we're seeing that in the economy, and we're seeing that slowdown of a recession. You do not get a massive recession, and that will tank businesses' profits, businesses' revenue, and that will have a snowball effect and affect employees. Employment is key. As long as people still have jobs and the job market is still really positive, people will still go out and spend their money. They might not be spending it as much as what they were doing, but as long as they've got money to spend, the economy should do okay. And the big thing as well is you don't get into the spiral situation where people cannot afford to pay, for example, rent, mortgages. When you're in that situation, that is when we start seeing an economy tumbling, and that's very much like we've seen in the 08 situation. The 08 situation got so bad because employment or unemployment started rising, and that's the key thing. As long as this holds up going forward, which it currently is doing, we should see it maybe unemployment increase a little bit, but as long as we don't start pushing up to 7, 8, 9, 10%, then we should have the economy hold in a very good place. And that's probably one of the key data points to be looking on in 2023. And that, if unemployment increases, will probably be one of the root causes for a tough 2023. And the last thing is valuations. Where are valuations at? Where are the businesses currently getting valued? Well, when we look at the likes of Adobe, which someone actually pointed out the other day, I didn't even realize this. Adobe's trading at 19 times forward earnings. I was like, whoa, is that actually correct? I didn't even realize, but that is correct. You've got something like PayPal that's at 18 forward times earnings. You got Meta down at 11 times earnings. PayPal that's the lowest price since 2018. Adobe that's the lowest price it's been since 2019. Meta that's the lowest it's been since 2018. Even some of the kings like Microsoft. Microsoft is normally untouchable, and even that's currently having a 30% dip. In Apple, now I do think Apple's a little bit still of a high valuation, which is a total topic for another day, but even that having a drop that it's currently on, it is a big sign right here. So when you look at valuations, small caps, the lowest valuations since they've been since 2008, since the last Great Recession. Mid caps, the lowest valuation since 2008. And some of the big tech, which are still holding on to okay valuations, even some of them are being killed 50% at the moment. So when you look at valuations have already priced in a massive dip. You know, a lot of the valuations at the moment are back towards where they were in 2020, 2019. And I don't even mean that from a share price point of view, which few share prices are. When you start looking at the metrics from point of view as well, a lot of the metrics, whether it be from EBITDA to, you know, revenue, enterprise value to revenue, whether that be to earnings, free cash flow, all the metrics are pointing to businesses being the lowest they have been for a long time. So this is massively in investors' favor at the moment. So going into 2023, I'm looking at the stock market, 2022, already having the worst year for 14 years. So there's already negativity priced in. Inflation, one of the main issues, is starting to flatten, which is positive. China, maybe not so much. Employment is still holding on really strong, which will be the root cause to what if we were to have a worsening situation here. And valuations are not expensive. They're not even, for most stocks, okay. Most stocks and most businesses at the moment are at the cheapest valuations they have been for many years. So that's massively in our favor at the moment. So when I look at 2023, will there be a stock crash? Personally for me, I cannot see a stock crash at the moment. Now the data can change and it can get worse, and then we might see a deteriorating market, a deteriorating economy, and we might have a poor 2023. However, at the moment, while I stare at the data at the moment, I'm seeing one of the main problems being resolved. I'm seeing this issue still being okay. I'm seeing this here. I'm seeing valuations being incredibly cheap and already pricing in a lot of negativity. Unfortunately, at the moment, until I see a situation that gets worse from here, I think going into 2023, we're in a very positive place where we could actually have a stock market that does very well in 2023. And at the moment, I would not understand why cash would be a good place to be. I would very much be thinking at the moment, when I look at the valuations, when I look at what's going on at the moment, and obviously when we get that Q3 data from a lot of businesses, I don't think this is a bad place to be as a buyer, because I think there's a lot of opportunities out here. And I think, like I was just saying there, the data at the moment, the valuations at the moment suggest that as long as things don't get worse from here, we are set for a very good run in 2023. So at the moment, I don't think there'll be another continued crash in 2023. In fact, I expect a very bullish year in 2023 when you look at the situation we're in at the moment and inflation being resolved, employment still being okay, valuations being extremely cheap. So yeah, I think that we are far away at the moment from a crash. That could change, and I actually would expect us to have a good 2023 in the stock market. So hope you enjoyed the video anyway, guys, and I'll catch you in a bit. Just let you know, if you are on the Patreon, I will drop the stock request video this weekend from the stocks that you guys picked on the Discord. But for you guys that aren't on the Patreon, I'll see you on Monday's video.